On 80% of days, the initial breakout in the first hour will fail and reverse, trapping early bulls and bears into losses before the real trend even begins. The first hour of the trading day is the most volatile and dangerous period. It traps novices who mistake volatility for trend, but it offers the day's best opportunities for professionals. This period establishes the boundaries that often define the rest of the session. In price action trading, we call this establishing the opening range. The most important statistic to remember is that the high or low of the day is usually formed within the first 60 minutes. Identifying which one has formed is your primary edge. It all starts with bar 1. The very first bar of the session gives you immediate clues about the buying or selling pressure. If bar 1 is a large trend bar with small tails, the market is showing urgency. However, if it has large tails or a small body, we are likely entering a trading range. We categorize the open into 4 main types. The first and strongest is the trend from the open. This is rare but profitable. In a trend from the open, the market gaps and creates a series of strong trend bars without overlapping. You must enter immediately, even at market price. However, most days are not strong trends. Most days open with uncertainty. This leads to the opening range pattern, where the market oscillates sideways. When the market goes sideways for the first hour, it enters breakout mode. The probability of a successful breakout up or down becomes roughly equal. Traders often lose money here by betting on breakouts too early. In a trading range, 80% of breakouts fail. Buying the high of the first hour is often a trap. Instead of chasing the breakout, look for the opening reversal. This happens when a breakout fails and snaps back into the range. Here is a classic opening reversal. The market breaks below the opening low, finds no sellers, and prints a strong bullish reversal bar. This is a high probability buy. Another critical concept is the gap. When the market opens far away from yesterday's close, the gap acts as a magnet. If the gap is small, the market usually tries to close it early. If the gap is large, it may represent a breakout on the daily chart and lead to a trend. Let's analyze the 50% pullback rule relative to the opening range. If a strong trend begins, the first deep pullback often tests the midpoint of the opening move. This leads to the opening range breakout strategy. If the market breaks the range with consecutive strong trend bars, we measure the height of the range for a target. This is called a measured move. If the opening range is 20 points tall, the breakout target is 20 points from the breakout point. However, you must distinguish between a vacuum effect and a true breakout. A vacuum occurs when price accelerates into a resistance level just to test it. If you see one huge bar accelerating to the top of the opening range, that is often a climax, not a breakout. Wait for a second bar to confirm. True breakouts require follow-through. A breakout bar must be followed by another trend bar in the same direction to confirm the move. If the opening range is very tight, small bars, lots of overlap, it acts like a coiled spring. The eventual breakout from a tight range is often explosive. In this chart, notice the barbed wire pattern at the open. Dojis, overlapping bars. This is a wait signal. Do not trade inside tight trading ranges. Once the market chooses a direction from the open, identifying the major trend reversal becomes the next priority if the trend fails. If the initial trend was up, look for a double top or wedge pattern after 1 to 2 hours. This often marks the high of the day. Remember the concept of the magnet. The opening price often acts as a magnet later in the day, especially on trading range days. If the market is ranging in the afternoon, price will frequently try to return to the open price to test it before the close. Let's summarize the decision process for the first hour. Step 1. Determine if the market is trending or ranging based on tails and overlap. Step 2. If ranging, fade breakouts. Sell new highs, buy new lows, but only with a good signal bar. Step 3. If trending, enter on the breakout or the first pullback, high 1 or low 1. Do not fade a strong trend from the open. The biggest mistake traders make is deciding a direction before the market does. You must be neutral until the price action declares a winner. Your goal in the first hour is capital preservation first, profit second. If the chart is confusing, the best trade is no trade. Mastering the opening range requires patience. Wait for the pattern to form, define your risk, and let the probabilities work for you. Wait for clarity, measure the range, and trade the probability.